Hey guys, today we are covering the 6 lessons learned after a decade of raising capital. So, a lot of people assume that raising capital is something mysterious that they could never do. They'll never be able to find the people. They'll never be able to get the money. And to be honest, we kind of thought this too when we first started back in 2007, 2008. Granted, there were different times. The whole market had just imploded, stock market, real estate. It was a very difficult time to raise capital. I mean, we were still in our 20s. Market was terrible. We didn't have a track record, but we were able to put it together. And part of the reason we were able to put the money together is because we got good at it. We developed it into a system. We weren't winging it. We basically turned it into a repeatable formula. And that's what we're going to teach here.
Yeah, so we're going to go through a few things. We're going to start off with probably one of the most important parts of making sure you're raising capital from the right people, and in particular, the right personality types.
Yeah, let's start with there. Let's start with the investor profile in general. If you're raising money for residential, some commercial, hard money lending, we've identified the best kind of candidate for you to target through a lot of trial and error, right? We've done it the wrong way, we've done it the right way, and we've got into a good system. So let's start with that. Your investor profile. We'll start with DISC personality types. And DISC, D-I-S-C, run that, there could be a whole training on DISC alone, but we'll run through it kind of quickly, and then feel free to do some other research outside of this training. So the D stands for dominant. This is your typical type A businessman or woman. They make decisions quickly. They're typically successful and intelligent oftentimes. I stands for influencer. This is your classic salesperson, your magnetic personality, your life of the party sort of person. S stands for steadiness. That's your executive assistant, mother hen, hold down the fort. Like, S's are very important. They hold the world together. And then you have C, which is your analytical personality type. Your engineer, maybe accountants, professors, like highly analytical types. You want to concentrate on D and on S. So your D, they're going to make decisions quickly. They're going to get your model. They're going to understand this very quickly because they're oftentimes successful business people, company owners, maybe they're attorneys or executives of some kind, and they will tell you yes or no quickly. They'll be great to work with. They have money. They are friends with people who have money. They're oftentimes golfers and country club people and good people to be associated with in general and to work with. D's number one target when it comes to raising capital. The other one is S. Your S personality type, they're going to be more of a passive type of investor. These could be family members, maybe somebody's uncle who has a bunch of money but isn't too savvy, like that sort of S personality type. It's important they're not going to understand the model as well, but it's important that they understand it. Like, we've always thought that you shouldn't take capital on from people who legitimately do not understand what they're investing in.
Yep.
But at the same time, S's kind of walk that line. Like, sometimes they're just passive people and they just say, all right, just you do the right thing. And you have to do that. You have to put them in the right deals, take care of them like they're your own grandma, and look out for them. Because frankly, when they're not as savvy, they don't look out for themselves as well. That makes sense? And just as important as the personality types to focus on are the ones you want to stay away from. Your I and your C. They're very different people. So I will oftentimes talk a good game, like maybe they claim they have money or access to it or something, but it is often just that. It's just kind of talk. It's just kind of like sales talk, and because that's part of their personality, a part of who they are. And oftentimes I's are spenders. Oftentimes they like to live the big life, and they don't often have a lot of investable capital. In C is an interesting one because sometimes you can confuse them with D's. When you get good at it, you can pick it apart, but like going into it initially, they'll oftentimes come off like a type A sort of person. Sometimes you can't identify them by their profession. I mean, like the engineer, like spreadsheet jockey, sometimes accountant, but there's good accountants too. We have some great accountants in our portfolio of investors. But being super analytical, overly risk adverse to the point that they can talk themselves out of even good deals. Anybody who's been through raising capital has had a lot of grief and heartache over the years working with C's until you realize that you should stay away from them. But until you get that, they'll kill you with demands and details and underwriting and then underwriting that. And oftentimes, even after you present everything you're doing well, they won't be able to pull the trigger. part of their, something in their personality just keeps them kind of on the sidelines.
Yeah, if you don't stick with the proper personality types, you're going to drive yourself crazy. And when you start off, it's challenging because anyone who's willing to invest money with you, invest money through you, you have a tendency to be like, oh, cool, you have $100,000. I'd be happy to deploy it for you. I can lend it out in these types of deals. And it's a mistake if they are the wrong personality type. It really is, because they're going to drive you absolutely crazy. I mean, imagine being babysat on a regular basis. And like Chris said, the C personalities are ones that come off as, hey, they understand the model, they typically have money, it's something that they're really interested in. And imagine just asking for status updates every day. So what happened with this? Did the loan close? Did they start the construction? Like, you can't have a babysitter. The purpose of this job and this business model is not just to go broker loans and do your thing. It's to run a serious investment portfolio, and you need to make sure that you have full control over it with the right people. And we've learned that the hard way, and we've taken on the wrong types of people. And it gets to the point it's like, listen, I need to find someone else to take over your position in this deal to buy you out, because my job is to grow this business and to do more deals and manage the appropriate things, not to babysit you, and understand why like a payment was 1 day late. So it doesn't work like that. So you really got to understand this trade of understanding who D's are and understanding I's are. And don't worry if you don't, or I'm sorry, D's are and S's are, and don't worry if you don't know much about it. If you Google Tony Robbins DISC personality assessment, you can access all of that. And one question that we've gotten a lot is, well, what do I do? Do I give this personality test to my private investors before I take them on? And you don't have to do that. I wouldn't do that. I mean, maybe for staff members or employees, it's a good idea just to make sure. But you'll learn across the way. You'll learn. Exactly what key traits are, and multiple people have multiple things. They could be, a high D and maybe like a middle I. That's okay. So you got to master it over time, and you will, by just kind of going through experience. And think about it. You should take it yourself so you know who you are. That's obviously important. And then as you meet people, talk to people, chat with friends, family, identify who the right people are. Because when you're sitting down in an investor meeting, an investor presentation, and one of the things I'm sure you've heard us talk about is making sure you're doing at least one investor presentation every week to determine who these exact people are. Because, trust us from experience, you want to take on the right capital partners, because they'll make or break this, make or break everything. So let's move on. Stick to your formula and your business model.
Real quick, let's cover a couple more points on the investor profile before we move on.
Let's do that.
A couple more things that'll shortcut this whole process for you related to the investor profile in general. All right, so we got the personality types. Focus on your DNS, stay away from your INC, and do your homework on DISC in general. Now, a couple more things about the investor profile. One is the amount of investable capital. So we made this mistake a little bit early on. We thought that if you're raising capital, might as well target the wealthiest people possible. It's actually not the best target for what we do. When you're paying people, depending on your model, your market, everything else, call it like 8 to 12%, something like that, return on capital. And of course, we cover exactly what we charge and how we break down in other trainings. So when you're talking about people in that range, it's a good return for them that is taxable. It comes with a 1099 INT, just like you get from a bank. It's interest income, taxable. The super wealthy people tend not to be that interested in it. It's not shooting high enough for them. That's our experience. At the same time, ultra wealthy people obviously invest in very conservative stuff and bonds and lower return, but that has been our experience for sure. And the good target, the right range that you want to stay in is, I'd say that most of our people are in the, call it like 200K to $1 million amount of investable capital. Now, we have people bigger than that. We have a handful of whales, you might call them. It's into 7 figures, well into 7 figures. But that's your sweet spot, that 200K to $1 million. So keep that in mind. And then also related to investor profiles in terms of the common professions, you're going to have a lot of business owners, people involved in real estate in some way. Finance guys are good, attorneys are good, CPAs can be good, make sure they're not too C personality. But those are some of the common professions that end up being your investors. So between the personality type, the common professions, and the amount of investable capital, you have a very good investor profile of what to focus on, what to stay away from.
Yep. Okay. So stick to your formula and your business model. Now, obviously, you need to identify what your business model is and what types of deals you're doing, but you cannot do everything or you'll just scare investors away because they're going to think you're scatterbrained. So I'll give you an example of what we do. We lend 65 LTV based off of the after repair value on fix and flip deals. That's typically what our standard deals look like. We also do 65 LTV or maybe lower reduced LTVs on refinances, either investment residential properties, sometimes commercial properties. But we clearly know what our model is. We've identified clearly what it is, so we can have an intelligent conversation with a private investor of like, these are the deals that you're investing in, and we turn them into widgets. Every deal is the same. You know, as you'll kind of see through the transition of this, is an investor doesn't necessarily get to pick and choose what transaction, what deal they're involved in with us, and which ones they are and they're not. They're all the same. They're all a widget. They're either a deal that gets through underwriting and it works, or it's a deal that doesn't and gets turned down. So you really need to clearly identify your formula, your business model, exactly what types of deals are working. If you want to put, maybe a credit requirement in it, whatever the case is. Typically, borrowers with higher credit will go up to 65 LTV. If they have lower credit and they're a bigger risk factor, we'll lower our exposure by lowering our loan to value of the deal. But we've clearly identified, and I think this kind of automatically came to us from the beginning, like we knew the types of deals that we were working on. So that helped, but the one thing you can't do is you can't have an investor meeting and be like, oh, well, we do fix and flip loans, we do deals here, we do deals there. We haven't done a deal like this yet, but we'd be interested in it if we have the right one.
Yeah.
You need a clear business model, and quite frankly, if you can keep it geographically targeted to your area that you're the expert in, that's even better. We only lend locally because those are the areas that we know, and most of our private capital investors are local for that exact reason, because they're local to us for the most part, maybe a state or two over, and they trust and know that we're the experts, we're the local experts on these particular projects. So the key word for that was widget. All the deals are the same. They either work or they don't.
Yeah, think about your investor meeting when, not even before you're pitching them a specific deal, but when you're actually just covering what you do. You go in with confidence. Here's our materials. Here's our model. We do residential and small commercial hard money in DC, Baltimore, and Philly. Boom. We know what we do. Here's how it pays. It's going to make them feel safe if you show them this is a proven model. You're not making something up. We're not doing some crazy complicated derivatives trading strategy. This is a proven thing. It's simple. It's backed by collateral. Here's why it works. That's going to make your investor feel good. And just like Jason said, what's going to make them feel a little skittish is like, oh yeah, we'll do some residential hard money. Maybe we'll do a big commercial development deal. We'll buy notes. We might buy properties ourselves using your money. Like, that'll make them feel uneasy.
Yep.
And that's what you need to avoid. You got to instill confidence in them by the fact that here's our widget, here's how it works, here's what it does.
Make sure you keep everything with your private capital investors easy and simple. You don't want to complicate this entire thing. This business model is easy. You don't have to be a brain surgeon. Like, it's not a hard business model in general, so don't try to overcomplicate it and look super educated and put together, some long white papers and everything else when you don't need to. Keep it simple, especially when you're dealing with deep personality types. They want to know the facts. The very, very easy. This is the property address. This is the collateral. This is a little bit about the character of the borrower and the capacity. This is what their credit is.
Yeah, it should be a one-pager.
This is why we think it's a good investment. Again, you're not dealing with analytical personality types. You're not dealing with C personality types. They're the ones that are going to want, a whole briefing, a 5-page report on some of these things. You're dealing with people that want to make quick decisions, and you want to make it, very, very, very simple. When we provide, documentation and information to our investor clients of, hey, this is the deal that you're going to be involved in, it's very, very simple. So they can look at it very, very quickly.
Yeah, definitely that. So don't think about you have to develop some crazy presentation with 5-10 pages worth of data and local market stuff and this and that, because your ideal investor client, they don't want to see that, like Jay said. And also don't give them a bunch of work. That's what about keeping it
Yeah.
easy and simple is about. Don't say go buy the property, let me know what you think. Like that sounds like work, and it sounds very flimsy. It's presented as, here's what it is if you can't invest in this deal, you can't invest in hard money at all. Here's exactly how it works. You don't have to do anything. Review the material. You provide them, totally transparent, everything. Review, approve, email me back, wire on this day, boom. You've already got your agreements in place. Like, don't give them work. Most of your investors are busy, successful people, and they don't want to be bothered with your stuff. They want it to be turnkey.
Yeah, exactly.
Yeah.
All right, so we briefly talked about this before, but making sure you're taking on the right clients. Don't take on the wrong clients. And the dispersonality type obviously is a huge indicator of that, and that's kind of step one. But the next part is, take on capital investors or partners that, are similar interests
that
as
you
you,
wanna work
people
with.
that you want to work with. Like, number one, you can't have a babysitter. Number two, you don't really want to have a boss. And number three, you want to work with good people that are like you. I mean, we've, over the years, I don't know, we've had 75 or 100 private investors that we worked with, and we're very, very tight with them in the good times, bad times, throughout. The purpose of it is we're all in this together to, write good loans, make good returns on our money, and you need to have the right people involved in that. It's that simple. I mean, over the years, there's only been a few, on one hand, maybe 1, 2, or 3 people that just, we just didn't, and even the deals didn't go bad. They just, our goals weren't aligned, let's just say. And it was like, listen, like, I don't think you're going to be part of this family. Like, it just doesn't work. Like, we're here to help. I'm here to put you in high interest rate return performing deals that are going to make you good money. And it's a win-win situation. So it's so important to take on those right people, those people that you can have real conversations with on a regular basis. So that's one of the hardest things when you start off with is anyone who throws money at you, you're gonna want to accept it, but you got to be disciplined. You got to be disciplined to make sure you're working with the right people.
Discipline is the right word. Discipline is a right word, especially when you're starting out. And we've been there. Like, we needed the capital that was coming from people. And we definitely, believe me, we've trialed and errored this whole process for you. That's the purpose of this training. We've done all the wrong stuff. We've taken money from people who we shouldn't have. And end up like, in all likelihood, it'll work out fine. It might not be the smoothest relationship, but loan will pay it off. They'll get their money back, and then you can go your separate ways. But have the discipline to walk away from that relationship if it doesn't seem like the right one. Because like Jason said, you have to be thinking about when things get a little rough. If a transaction goes into default, if things get rocky, you need them to be on your side. You need them to be on your team with you and your partner and your investors and your company, not against you.
Yeah.
Right? So if you feel like they're going to be adversarial in their relationship with you investing, that is a huge red flag.
Yeah, I mean, the last thing you want is a deal that goes sideways for none of anyone's reasons. It just goes sideways one way or another, and you're trying to foreclose and get the property back and do whatever you can to recoup the capital, and then you have your investor over here pissed off because they're not aligned with you, and they're trying to sue you to get their money back, and then you got to fight with the borrower, and then you got to fight with your investor.
Right.
You need someone who's aligned with you and understanding the goals, and maybe a conversation of like, listen, this deal went sour, this happened, this. Maybe, let's turn it into a rental property. We can co-own it. I mean, you don't have to do it that way, but like there's a lot of different options when you have the right capital partner in place that, you can use. So, okay, so next thing, always have good communication and set proper expectations. I mean, expectations is huge. That's one thing, like we've always been good with kind of communicating the good and the bad with our capital investors. And like we said earlier, related to like you don't want somebody micromanaging you, that doesn't mean you don't communicate with them. We still communicate with them. Typically, we're providing updates through payments that they're getting, so they get reporting there. We'll do monthly calls with them of like, hey, here's the status of your current portfolio. Here's what's going good. Here's what's going bad. Things like that. But constant communication of what's what. Like that's important. I mean, they're not shareholders in your business, but sometimes you got to think of them as shareholders. As they put up the capital, you have an obligation to make sure you repay their capital, their principal capital first. That's always important whenever you take on capital, so you got to do whatever you can related to that. But good communication, and obviously more important, especially from the beginning, just set proper expectations of what's going to happen. And if you set proper expectations from the beginning, your life's going to be so much easier because then they know, hey, I'm not going to call you every day. We're going to do once a month calls. You set that up on the front end, and it makes your life so much easier.
Yeah, and the thing to keep in mind is everyone has a tendency at the beginning when they really want to take care of their capital investor to overpromise, to set expectations too high. You're going to hear from me all the time, and blah, blah, and here's what will happen. Here's a tip, actually. You don't need to have any updates being given out on performing loans. You just don't. If they're doing their construction and making their payments on time, there's no update required. That's going to save you a headache because from experience, I can tell you, if what you might want to do and what I did in the past is say, we'll keep you updated along the way if it's a rehab loan, as they're doing work on the property. Then that's okay in theory, but once you get a few loans outstanding, and then some of those loans you have different investors involved in each loans, it's like, okay, now every week I'm giving out a few dozen updates on what's going on with these properties. Skip that. No updates on performing loans. It's performing, everything's fine. You send them whatever kind of system you're set up for. If it's a monthly statement like we started out with, then we move to weekly interest payments, stuff like that. But anyway, just starting out with a monthly statement, here's your portfolio, and here's like the next due date and like the loan amount, just so they can see, just like a bank or investment statement, anything like that, same kind of thing. So being set up for that as soon as you can with software is important. And then setting up the structure for when they do receive updates. Some people don't want to talk about their portfolio. They don't care. Like a lot of S personality types, it's like they leave it up to you. But setting that up with your investors, like I have probably maybe 3 investors who want to do a monthly call, and we do that without fail. We do a monthly call, review the whole portfolio. Fine. 90% of our people, they don't care. And they'll get their monthly statements and trust that we'll clean it up if they have a couple defaults or whatever, and everything is fine. But setting up that system of communication up front and not over-promising. Those are the goals.
Okay, next one. One of the most important is making sure you're transparent. Always be transparent with your private investor. Treat them like a partner. They're a capital partner inside this. Whatever you know, you need to portray to them so they know, especially if they're making their own educated decision if they want to invest in a particular note with you or a particular deal with you or not. So the way that we have it is we do everything on Google Drive, and then we give access to the folders per file that's set up. So everything we have, they have. This isn't like back in mortgage brokering days where it's cool, let's just collect all this information, let's scrub it, and then let's send what we want to the underwriter for a decision. Like, it doesn't work like that. Everything that we have access to, they have access to. And if we come across something in underwriting that doesn't work, the deal has to die. It doesn't work. It either has to get turned down, or you have a conversation with that. Maybe the investor thought something that has changed. You have a conversation with them and say, hey, listen, this just changed. Unfortunately, this deal doesn't work now, or we're going to adjust this or this or that. But you need to be transparent. Everything that you have, you got to give them access to. So they have access to everything on the front end. They have access to, as payments are being made, they know exactly if payments are being made or not being made. But it's going to make your life so much easier. This is the type of business that the loan is not over until the loan is matured and paid off. It's not on the front end. Yeah, the majority of the money comes on the front end with points and fees and stuff like that. But the real test is 12 months from now when the loan is repaid and matured and satisfied. That's what we did our job for on the front end. So you've got to think of yourself that exact same situation. You need to be transparent along the way.
100% transparent. All right, let's do a little recap.
Okay.
Let's do a little recap. All right. So the most important thing to keep in mind is that raising capital is not that hard. It's not impossible. You don't need to be afraid of it. It's not mysterious. Follow some of the things that we've talked about related to your investor profile, right? Target the right people. Save yourself a bunch of headache. We already figured this out for you. Target the right people, skip the other ones, and have the discipline to do that. Stick to your formula. Don't throw at them, we do a bunch of different kinds of deals and this and that. They will be nervous. And you want your investor to be confident that you know what you're doing, and you stick to your guns and you execute your plan. Make them feel good in that way. Make it easy and simple on them. Don't give them a job. Don't give them homework. They already have their own businesses. They already have their own profession. They want you to make their life easy and predictable.
Yeah, they're coming to you as the professional, as the hard money lender. They want to invest money with you. They don't want to do the hard, heavy lifting themselves. They don't. They, maybe some of them do hard money themselves already, but like the money they're allocating to deploy with you, they want their life to be easy. They want a passive investment on a good asset with a good rate of return. They're coming to you. They're putting their trust with you. So,
Yep.
it's not the hardest thing in the world. Like I said, we've done it. Got a $35 million portfolio under management, and it's a good size. And it could be awful because if we wanted it to, by just taking on the wrong people and scattering and doing this all over the time. But it's a good performing portfolio that works for us with the right capital partners, with the right people in place, and it made our life easy as we ramped up along the way.
Yep. Also, have the discipline to not take on the wrong investor clients. Or if you find yourself in a position where you had somebody fund a deal that might not be the best partner, to let them go after that deal, right? You're going to save yourself a lot of trouble. It's not going to be good for either side. Have that discipline. Don't take on the wrong capital, even when you need it. It'll be a problem later.
All right, guys, keep us posted as you raise capital. We'd love to hear about it. Thanks.